macro data that came in from US, where the December CPI reading has come in at 6.5%, in line with the estimates. The street was expecting inflation to slow down in the US. As it is, this reading could help determine the size of the Fed's next rate hike. Now, core consumer prices has risen to 0.3% on a month-on-month basis. Now, remember, last month CPI came in at 7.1%. Now, let's take a look at what the experts are making of this print.
I'm very bullish about equities in 2023 globally, and I think that the data we had today, frankly, underpins that, because basically the sharp drop in inflation, albeit it was in line with expectations, and I think what's happening with the data today is people are saying, sell the news that maybe the market anticipated this nice drop in inflation, and wait for the Fed to give us their reaction, if you like, and some sort of change in rhetoric. My own view is you're probably going to get another 75 basis points of rate hikes, but we're very close to the peak, and as far as I'm concerned. And I think that's very good for the equity market in 2023. Dollar goes down, bond yields have peaked, and the Fed is very close to ending their tightening campaign, even though I'm not sure they're going to be able to cut rates in 2023. Now, what the economy is doing is a couple of points I made very quickly here. You may well get a mild recession in 2023 in the US.
Well, and the US economy, beg your pardon, is primed for disinflation this year, but the path back to the Federal Reserve's 2% target will be bumpy, according to St. Louis President James Bullard. He also said inflation remains high, but is moderating. Meanwhile, the Federal Reserve Bank of Philadelphia leader Patrick Harker said that while the central bank needs to raise rates more to cool off inflation, it can probably do so at a much slower pace compared to the action of last year.